And I would like to present a very special guest, the former president of the IFO Institute and maybe the most famous German economist, Hans-Werner Sinn.
Yeah, hello, and thank you for the invitation to speak here in this wonderful setting, in particular outside. I was really amazed to see and realize the atmosphere. Don't expect me to talk about bitcoins because I know very little about it. I know more about your competitor, the old money, and this is the subject about which I want to talk. I mean, the common thing, of course, is if you start such a thing, is seigniorage. You create a money which others accept as a medium of exchange and give you real things to live on. So the person who can create this currency becomes rich because he can exchange the currency for consumption goods in the end and live a good life. And the others, well, they have a medium of exchange which serves them valuable functions, and they are not forced to hold the money. They do that voluntarily. So it's the liquidity services of money, which is the opposite of it. And this is the reason why economists tend to argue that money is real wealth. So if you create money, it makes the society really better off relative to a situation where you don't have it. It's not just that one gains and the other loses. And this was the reason why in the past kings always insisted on the right, the unique right to print money and pay for the services they were buying in the private economy. And this is the reason why, of course, the central banks of the world see with big skepticism what is going on in the cryptocurrency world. That money is valuable if you can use it is demonstrated very well by the history of the new European currency. It turned out really to be very useful for some people, and it has created a lot of wealth for some people. Whether in net terms there is a benefit is doubtful. My colleague Jean Pisani-Ferry, who was probably the most influential French economist for a while, has just said that the euro idea was probably not such a good idea. And it was the French who wanted it. They wanted it deliberately when they suffered from the fact that the German government always had lower interest rates than the French one, and in particular lower interest rates than many other European states. And this privilege of which the Deutschmark gave the German state, they found unfair, and they wanted the new money in order to have lower interest rates. And it worked. It worked. The new currency was decided in principle together with German unification, not formally together, but actually together in 1991. And in practice, however, it was decided at the Madrid conference of the heads of state, the summit in 1995, when there was the agreement ultimately to now begin and do it. And they fixed the date by which the new virtual currency would be there. That was the 1st of January 1999, and physically that currency came 3 years later in 2002. And the result was that indeed the interest rates of those European countries which had difficulties borrowing declined rapidly towards the German level. Spain, Portugal, and Italy had interest rates at the time, annual interest rates for 10-year government bonds of 12%, Germany of 7%. It was still the old time when we had interest rates. And within 1.5 years, from the Madrid summit in December 1995 until May 1998, when the exchange rates were irrevocably fixed for the entry into the new euro currency, this interest gap relative to Germany disappeared completely. Italy, for example, but similar story is true for Spain and Portugal, saved as a state so much money by having the interest rates reduced that they could have abandoned their value-added tax. And still there would have been a little surplus. So big was the advantage. Everywhere the interest rates declined, and then in the years thereafter even the German rate declined gradually, and so everyone followed suit, and everyone and you couldn't see the interest differences anymore. This was a bonanza period in Europe where everyone was so glad with the euro, the first 10 years of the euro, because money was available for each and everything. The governments could use the money from reduced interest rates for other purposes, or didn't have to increase taxes, which otherwise would have been necessary. And even more, they could borrow at lower interest rates and have the borrowed funds in addition. And this is what they did. In Greece, it was the government, Portugal, Greece and Portugal, it was the government which borrowed. The government increased the salaries of government employees, increased the pensions. The pensioners had money in their pocket, could go to the restaurant owner had more money, could go to the hairdresser, and so on. There was a multiplier effect. And in Spain and in Ireland, the story was slightly different insofar as there the governments were rather prudent, but the private sector used the opportunity to borrow, because not only government borrowing became cheaper, every sort of borrowing. Banks in Spain borrowed in the European interbank market and were lending out the money at low rates of interest to people who wanted to build a house or buy real estate. A construction boom developed. There were many jobs in the construction industry. The unions could increase the wages. And the workers had the money to go to the hairdresser, and the hairdresser to the restaurant, and so on. It was basically the same story. It didn't matter really much how the money entered the economy, via the government sector or via the private sector. So this was a wonderful period. It was a boom period. The boom became a bubble, and the bubble burst, as you know, at the time of Lehman, actually a year earlier in 2007. All of a sudden, capital markets became critical about over-borrowed, over-indebted countries in Europe, and were not willing to lend further funds to these economies. And that was the crisis. The crisis had not begun in Europe. It came from America. It's the subprime crisis. But you know, it changed the whole world, and the risk aversion of investors all of a sudden increased. And those countries which had used to borrow a lot and became accustomed to this method of financing their budgets, those were in difficulties. Okay, then came the actions of the European Central Bank and of governments. They guaranteed savings accounts, and the central banks offered banks the possibility to borrow money from themselves rather than from the market at low interest rates, and that was for the time being the solution. It was a solution in particular in Southern Europe, where markets shied away. So there was extra money printing in Southern Europe relative to the size of these economies, and this extra money was used to continue buying goods in the north as before, but before the money was lent from the banks in the north, and now it came from the own printing press. Actually, you should know we have a common European currency, but the money is not coming from Frankfurt. Yes, it comes from the Bundesbank, but not from the ECB in Frankfurt. The ECB basically is just deciding what is to be done and gives the general framework of rules. The money printing and issuing of money is done locally. Everyone has its own local central bank. As before, the old central banks remained intact and remained the property of the respective local states, except that they coordinate their policies. That's a speciality in Europe. And if you have the printing press in the basement, it is tempting, if you have financial needs, to print a bit more. And this is what happened. And this bit more is actually measured through the so-called target balances. They measure the net payment orders from one country to the rest of the Eurozone. And in Southern Europe, there was a lot of extra money printing which allowed these net payment orders to other countries to be made for the purpose of buying imported goods, as before, for the purpose of redeeming one's debt with the creditors in the north. This is why the creditors in the north applauded this policy. The German banks, French banks in particular, they were very glad about it. And money printing for the purpose actually of buying some assets also in the north. I looked in detail at the Greek situation, and here it was so that the extra money printing in Greece was spared in equal parts for three things. First, sustaining the living standard in Greece, which was beyond what the productivity of that country allowed. So Greece was living beyond its means. Huge current account deficits, to explain it from the technical side. The second was to redeem the debt, the private debt, with foreign investors. They all applauded. I mean, not only the banks, but also other investors. Ask yourself why Wall Street applauded. Of course, they had their investments in Europe, and if the creditors were able, with self-printed money, to redeem the debt, they were bailed out. And this bailout process was liked by everyone. Was liked by the Southerners because they were able to service their debt, and by the creditors in particular also, because they got their money back. And the third thing was, and actually it covered 1/3 at the time of the overall asymmetric money printing of the target balances. The third thing was buying assets abroad. So surprisingly, in the midst of the crisis, investors from Greece spread out all over Europe and bought assets. From what? They were in crisis, and they were able to buy real estate in London or here in Berlin. This is possible if you have access to the money printing press. Now, this asymmetric money printing was made possible. It was not illegal, it was legal, because the ECB Council made the rules under which this all happened. But the rules gave a lot of flexibility, and this flexibility was used. It was made possible, for one thing, through ELA credit, emergency liquidity assistance. So one central bank, any central bank in Europe, can declare emergency. And if it says emergency, it can print as much money as it wishes, lend it out to domestic banks. They would lend it out to the government or to the private sector to service their financial needs, whatever that is. They don't need the permission. Once they declare emergency, they can do it. Okay, the ECB Council in retrospect can say, we don't like that, and we stop it. But the first thing is they have the right to do it. And they can stop it, the Council can stop that only with 2/3 majority in the Council, but it happened at the time that the 6 major crisis countries of the Eurozone had 1 vote more than 1/3 in the ECB Council. So it was basically impossible for the other European countries to say no. The crisis countries were Ireland, Italy, Portugal, Spain, Cyprus, and Greece. Yeah. So these 6 countries, and they had 1 vote more at the time. Later, Latvia entered the Eurozone, and this was no longer true. But that helped for a while. That helped also calm the markets. The spreads, which had exploded, came down again. But it was not really a convincing solution. The markets again became nervous in 2011 when the spreads went up. That was a difficult year. The economy in Europe went down. The markets showed their distrust with Italy and Greece. Papandreou at the time and Berlusconi had secret negotiations, as we can read in Bini Smagi's book. Bini Smagi was one of the directors of the ECB. You know, they had secret negotiations about a euro exit at the time. And Papandreou said that 3 years ago in Munich at the eve of the Munich Security Conference, in public, he wanted to exit, and it would have been better for Greece to exit, he said. So they wanted to exit, but the others didn't want them to leave. And so these 2 guys had to exit themselves, and actually they lost their jobs and quit it in the same week in the autumn of 2011. These are all stories which are true, which you can prove with the respective literature, and not just anyone writing it, which are not communicated in the public. But it didn't help. Markets became increasingly nervous, and the peak of the crisis was in the summer 2012, when the spreads went up, were shooting up enormously. And it seemed that the end of the Eurozone would be near. And then came Mario Draghi as a savior of Europe, in a sense. He said, whatever it takes, we will rescue your portfolios. Yeah? Because if you have the money printing press, you are rich. You are rich. You have lots of resources to help, and in this case, to help repay the old debt, and that was convincing. In particular, the ECB made this OMT decision, outright monetary transactions, a name which says nothing about what it means, according to which the ECB said to the market, don't, for example, be afraid by buying Spanish government bonds. Should Spain go bankrupt, we will buy these bonds out of your portfolio in an unlimited way. Okay, some procedures. First, Spain would have to declare that it is in difficulty. Then it would be getting money from the ESM, the European Stability Fund, a fiscal fund, which in the meantime had been set up with rules of behavior, so it's not that easy. But once Spain would do that, and they certainly would do that before they go bankrupt, the ECB would then step in and buy everything which is necessary to prevent the bankruptcy from happening. So it's an unlimited bailout guarantee which was given to the markets, which rescued the portfolios, and rescued the euro in 2012. But it turned out that that was not, in the long run, really sufficient to just make this guarantee, give an insurance promise, in a sense, or offer a CDS contract which you could also buy in the market, but you would have to deliver. And so it came to the QE program, which was discussed in 2014 and then decided in January 2015. QE means quantitative easing. Again, the name says nothing about it, what it means. These are these floristic names which cover actually what is being done. So what it means is the ECB said it will buy, its local central banks will buy government bonds and private bonds to a certain amount, and huge amount, with money from the printing press, but symmetrically. Everyone prints money in proportion to its size. So this period of asymmetric money printing was over, but there was a flood of money instead. Everyone had enough money, and that helped to solve the situation. Until the end of last year, the ECB bought for 1,900 billion euros government bonds. So all the single central banks bought the government bonds of their respective home countries in proportion to size, to economic size. Plus some hundreds of thousands of, some hundreds of billions of private securities. The total amount of central bank money which was circulating in the Eurozone through this action increased from 1.2 trillion to 3.2 trillion. And we are currently living in this situation of a flood of money. This is why the interest rate is so low or even negative. This morning I looked it up. The German government can borrow for 10 years at a rate of minus 0.24 or so %. And even Italy is able to borrow at a rate of interest which is comparable to that of the United States of America. There was a time, a year ago or some months ago, Italy was even able to borrow at a lower rate than the United States of America. Very easy to understand why, because the customer buying the Italian government bonds would be the Banca d'Italia. Yeah? In the end, it would be the Banca d'Italia, and they would buy whatever they can get at very low rates of interest. So this bonanza period, in a sense, is there, but to be fair, it's not that pleasant for Southern Europe. Southern Europe is still in a deep, deep, deep crisis. Manufacturing output in Italy is 18% today below what it was at the peak before the Lehman crisis. Germany is 8% above the pre-Lehman maximum. Spain is something like minus 10% relative to the pre-Lehman maximum. Portugal, what is it, 14, 15% minus. And countries like Spain and Greece, minus 21% relative to 2007. Some people say these economies have recovered, are recovering. I don't see it. You see it in terms of those sectors which are not in international competition. That is the hairdressers and the construction workers and everything which is internal. You know, that works. But if you look to those sectors which have to face international competition, they simply don't work. In Italy, in the last decade, 1/4 of the manufacturing firms in net terms has disappeared. Even if you subtract the few new foundations that in the meantime has happened. There you understand why the Italians are so nervous and why last year they elected the Lega and the Cinque Stelle. You know, this is the party with this clown. The clown is no longer important, but the party is there. And these are powerful parties. And in the European elections, Salvini, the head of the Lega, is the big winner. So the political landscape in Italy has changed entirely because of the crisis of this country. And this is the phenomenon. It's an unlimited amount of public money, mutually guaranteed through the ECB system, and still the economy doesn't function. The reason is that Italy is too expensive, and the others too. They became too expensive in the pre-Lehman bubble. You know, initially, when the interest rate declined from 12 to 7%, as I explained to you. And then the 7% declined also further. When money was available for each and everything, and you know, this excess demand by the government sector due to being able to borrow nourished the internal economy, and the creeping loss of competitiveness in the manufacturing sector was not so important because you had enough jobs elsewhere. They never really prospered. Italy always had difficulties, but there would have been a disaster without the possibility to borrow at so low interest rates. And Italy became more expensive. You know, this extra demand financed by borrowing through the government sector allowed wage increases and price increases, which destroyed the Italian competitiveness. If you increase wages beyond productivity increase, you have to increase the prices. But if you're in an international market, you're out. You know, then the result is unemployment. And this is the problem everywhere. Italy, up to this day, relative to the time of the Madrid summit, with which I began, when the euro was ultimately decided, has increased its price level for its self-produced goods, the so-called GDP deflator, by 39% relative to Germany. So it was an extra inflation over the years of 39%. Or translating it into ordinary language, suppose Italy still had the lira and had revalued it by 39%. That is the situation. No economy can survive that. And this also tells you that there is no easy way out. So what should they do? Become cheaper? It's easier said than done. You first have to fight the unions. Fight the unions in Italy. You will have a civil war. It's hardly possible. They are very, very strong to depress the wages. You could, of course, hope for productivity miracles. So if productivity goes up and wages don't follow, then prices might fall. But this is an irrelevant hope. The only thing which you can really consider is you re-inflate the North, so inflate Germany to make Italy competitive. But it would be quite a bit of inflation, and the Germans don't like it and don't do it. Germany is a big tanker, which the ECB, even though it tries hard, has not succeeded in inflating. The next possibility is you make a transfer union. That is, you take tax money from the North, pay it every year to the South, to give them the possibility to buy imports. Given that they can no longer sell their own exports to the extent necessary to finance the imports, you could make the money a gift. So then you could sustain the living standard. But you won't help the economy. To the contrary, because you sustain a wage level by that policy which is not sustainable. You bribe the political elites so that they are somehow content with the situation, but you are not solving the situation. And the third is exit. Like Berlusconi wanted in 2011, like Papandreou wanted in 2011, the Italians now are openly discussing the possibility of an exit. And this is why last week they made an important pre-decision to introduce a parallel currency, the so-called mini-bots. Mini-bots are government securities, like the IOUs in California. We had that already. These are government bonds printed on a nice small paper, looks like money, is money actually, and in small denominations, 1 euro, 2 euros, 5 euros, you can hold them in your pocket and you can go shopping with them. Actually, the government would accept these mini-bots if you want to pay your taxes, and therefore they have a market value. And this is what Italy currently is preparing. The big debate. The newspapers today, yesterday, are full of the mini-bot story. At least it's a bribing instrument. The Italians would say, if you don't want us to make a parallel currency and stay in the euro, you have to come over with a transfer union and somehow assure that the money comes elsewhere. On the other hand, their lip service is in the new parliament fraction, yesterday also it came in TV, they don't want to have a transfer union. They say that, but they want one. So it's a very difficult situation. It's a mess. We don't know what comes out. Yesterday, the day before yesterday, Marty Feldstein, the great American economist, died at the age of 79. He, before the euro was introduced, wrote an important article, said it would never function, it would create nothing but hassle and strife in Europe, because he foresaw the sorts of difficulties which we are having today. So I'm not able to make a prophecy of what will happen, except the hope that we would be through, which I hear regularly being repeated by European politicians and the ECB, loses being convincing. Now I'm happy to discuss this situation with you. Thank you.
Yeah, thank you so much. Yeah, please come to the front and ask really hard questions, and we're going to get some high-value answers, of course. Also, I wanted to ask you something. If I'm not mistaken, maybe on a talk show or some other things, you spoke out in favor of possibly banning Bitcoin. And I think that a lot of people here come to the same similar conclusions that you come to regarding euro, money, printing money, interest rates, et cetera. A lot of people align with your conclusions, but maybe on that case of a possible ban of Bitcoin might disagree. Could you tell us about that?
I'm not sure whether you remember correctly.
I might not. That's why I asked you.
An economist distinguishes between a forecast and a proposal,
okay.
A normative and a positive statement. So my prediction is if the Bitcoin succeeds, then there will be legal actions to constrain it severely, which will mean that it loses some of its attractiveness.
Okay.
Can you define succeeds?
What?
You said if it succeeds.
It succeeds in crowding out the existing financial industry.
Okay, sir, please.
It's about the,
go into the mic.
The Italian, I think it should be the Itcoin, of course. But is it legal to have your own national coin under the European contract?
No, I don't think so. But they argue it's not a currency, and we don't have coins. It's only paper. It is government bonds, and the government bonds are not illegal. Government bonds are things written on paper. The government gives you a paper and says, this has a value of a certain amount, and people accept it voluntarily, except normally it has a due date and a rate of interest. In this case, neither. So that makes it close. Actually, it makes it money, but the Italian government argues this is not money, this is just government bonds, and therefore it cannot be forbidden.
Please, more questions. One of our favorite question persons, Christian.
Yeah. Hi, you said that the ECB was also buying private bonds. This, as far as I understand it, that's credits to private companies. There was happening some stuff like Poco-Domäne, I read in Tagesschau.de. Is this still going on, and why is this happening, and how secure were those kind of bonds credits?
It's still going on. They are not increasing the quantities in the moment, but there's a lot of replacement purchase. So old bonds become due, and rather than letting the stock decline, they buy the same amount again in the market. So that basically the issuers of these bonds have the possibility to get the money to redeem the old debt.
Anyone else? Please.
Just curious about if you have an opinion about the modern money theory, which is in America pretty famous now, and I'm pretty sure it will become also a topic during the elections. Yeah, your opinion.
Yeah, well, I share the opinion of Kenneth Rogoff, modern monetary nonsense. Because the idea is the government can buy a government bond. The central bank can buy a government bond. The government has the money to pay its employees, buy goods in the private economy, build roads, whatever. And if the government goes bankrupt, there's no loss, because the ECB could, or whatever the central bank is, could quickly print more money and buy new government bonds with that money, and so it could go on. Whatever the default loss is on assets which the ECB bought, it's irrelevant, because you can print more money and replace the defaulted assets. And you know, the defaulted assets would generate interest income for the central bank, and that interest income would replace the loss of interest income on the defaulted assets. Everything is fine. The problem, though, is there's more money in circulation. And if you have an optimal monetary policy, you have to deviate from the optimum. And if you go to the other side and have more money, then there is an inflation risk. Now these people say, where is the inflation? There is no inflation. And so we can do that in an unlimited way. But that is a dangerous point of view, because inflation is like the ketchup bottle problem. No? You shake, the bottle is open, you take it from the fridge, the ketchup simply doesn't want to get out, and all of a sudden all comes out.
Another question?
I hear all the problems, but I lack to hear the chances we might have. Is there anything good that might come out of it? Is there maybe a chance to change the governance, to get, for example, private banksters out of our central banks? The president of the ECB is from Goldman Sachs originated. So how can we get out people that have clearly different interests than the public out of our central banks?
Oh, you make an assumption about Mario Draghi, which I would not share, to say that frankly. I don't think we should go at people, at persons. He is a clever central banker. He knows everything. And I think it is fair to say that he rescued the euro. The question is at what price, and who bears the losses, what would have been the alternatives, and so on. No, it's not an issue of exchanging people. It's a rather fundamental economic conflict which we see here. We are trying in the moment the impossible, namely to sustain an economy with wrong relative prices forever. That won't work.
Please.
First of all, just thank you very much. Really enjoyed that. Your last sentence was my question. How long can this farce go on? how long can this continue? Because it's clearly broken, fundamentally broken. You know, I've been following a guy called Max Keiser, you know, the financial journalist, the American guy, and he's been saying it's got to fall over soon, but it doesn't. It keeps getting the can kicked down the road by politicians, by central bankers. When do you think D-Day is going to come, where it will just have to collapse?
Yeah, well, this when question an economist can never answer.
Your best guess.
No, I don't speak about time. I don't know. What I think is most likely is not that there will be a big crash. Most likely is that Europe settles to a secular stagnation in the sense that we accommodate these differences in these deviations from the true and optimal relative prices, except mass unemployment on destruction of industries in some parts of Europe, and finance it permanently with transfers from the north. This is the likely solution which we will get, because this is the solution which we have internally in Germany. East Germany was joined 30 years ago. We pushed the wages of this bankrupt ex-communist economy within 5 years to the West German level, which at the time was about the highest wage level in the world, destroyed 3/4 of manufacturing jobs, and created government jobs and created income by having transfers from the West to the East. And these transfers still go on, and they will never end. You can do that if the population is small, then the others can afford it, but not when it is a big percentage. And unfortunately, the percentages in Europe are different, because 40% of the Eurozone population lives in crisis-affected countries with this disease. And in Germany, it was 20%, which lived in the East. So the 80 could finance the 20, but will the 60 be able to finance the 40? That's a completely different issue. And apart from that, the receivers, the recipients of money, would permanently stay too expensive and be in a situation which we economists call the Dutch disease. Dutch disease, Holland, Netherlands found gas in the 60s, became rich, living standard went up, wages went up, industry destroyed. Because the one sector prospered and the government collecting taxes prospered, paid high wages, and industry simply could not compete with these wages and was decimated. And only when the gas price fell in the 80s and the stocks went down did the Netherlands recover from that disease. You know, other country, Norway has the highest wages in the world. Look for manufacturing in Norway, not existing. Or look, to take an extreme example, Venezuela. The oil industry has destroyed the whole rest of the economy because it has created a living standard at which no manufacturing firm could ever survive in the international market. That is the sort of problem. If we do that to a limited extent, Europe might be able to survive, but it will stop growing. It will be a permanent stagnation, and that in a time when China, Asia, and other countries are still growing. I think we cannot afford it. But it doesn't mean the euro explodes.
You mentioned Venezuela. Could you imagine that the European governments, instead of banning Bitcoin, they will follow the shining example of Venezuela and issue their own cryptocurrency, like the Petro? And what would you think of such a move?
Yeah, talk to Matteo Salvini. He will have open ears. He has already this old-fashioned mini-bots, and if you do that with the cryptocurrency version,
I'm against that.
He might be listening to you.
Any more questions?
Yeah, of course. We've heard a lot about competition. Isn't it a chance now that we have with Bitcoin a really strong network money that will enforce competition as a competitor in a currency view for a government to do a better job than you describe it, actually? What is your opinion about?
And I like competition. I have nothing in principle against the popping up of cryptocurrencies as competitors. The problem is, however, the seigniorage. You generate the seigniorage out of nothing, and this traditionally was considered to be a privilege of governments to do that. It has a strong redistributive implication, and the question is what the taxpayers will say to that.
Okay, last question.
Is it possible to decentralize euro? So basically to have Spanish euro, Belgian euro, Hungarian euro.
Yeah, we were like that. Before the euro was introduced, it is of course possible to be there. Whether it is possible to go there is another question. It's like a scrambled egg, you know. Is it possible to make ordinary eggs out of scrambled eggs? Very difficult. Everyone is afraid of the mess in the financial markets, and right so. So this is not what I would propose. I am proposing a breathing currency union where we allow countries which don't make it in the euro because they are not competitive to exit, rather than nourishing them forever with common money. So give them the chance for an orderly exit and find some way of solving their debt problem. In my book on the euro, which came out with Oxford University Press 3-4 years ago, I advocated haircuts for the existing government debt, the existing bank debt, and also the target debt inside the euro system, which had been built up. Push the reset button for a country exiting and make it possible to exit in an orderly way, and also give it a chance at a later point in time to return. So in the case of Greece 2015, I was really advocating this solution. And I'm not advocating it because I'm German, or it has nothing to do with it, because Papandreou advocated it himself, you know? They wanted it. Varoufakis wanted the exit. You know, he prepared a parallel currency. You can only do that if you are playing with the idea of exiting. Exiting has the advantage you can immediately devalue and regain your competitiveness within minutes, which otherwise would take a decade or two or would never happen. Because you cannot easily cut wages and prices in an existing currency union in order to regain competitiveness. Everyone says, begin there. Why do you cut my wages? Cut those wages of the other people. And you cannot easily coordinate this mutual wage cut. If you could do that, all prices, all wages simultaneously go down to regain the competitiveness, it would be fine, but you can't. You have long-term contracts, rental contracts, credit contracts, and so on. You cannot. The only way to do that is a formal exit out of the currency and the devaluation. That is something which would work. And I think it would be better to allow countries to do that. I would not kick out anyone, but my position is don't expect money from the others when you want to stay in. It's your own decision, but if you want to exit, we help you in doing so.
Are you describing that jubilee?
What?
That jubilee.
No.
When you just write everything off. Is that what you're saying?
The Jubilee is when you just forgive everyone's debt.
Not everything, but half of it, or what? There should be a significant haircut. You know, the world since the Second World War has seen 180 state bankruptcies. A bankruptcy is not a problem, it's a solution to a problem in many cases, because the debtor gets rid of these nasty creditors by a haircut. So it allows to breathe again. You relieve the burden of the debt, you become competitive, and you can restart. What we are doing in the moment is we destroy the life of one generation of young people in southern European countries, which are unemployed and have no chance because the economy just doesn't get going. They are unemployed. They are sitting at home in the mother's kitchen and become 40, and still nothing happens. This is a disaster for Europe. We cannot accept such a solution. Of course it is difficulties. Financial markets are difficult. I have no illusions about that. But it's a multifold problem where you have to take many things into account and not just the safety of some portfolios of some investors from somewhere in the world.
Thank you, thank you. Okay, thanks a lot.
Thank you so much for visiting our modest conference. In the beginning, you said you don't know that much about Bitcoin, so I want to give you this book about Bitcoin Austrian economics. It's for beginners.
Oh, thank you very much.
Thank you very much.
I like competitors. There is another competitor upstairs. I have that book too. Okay. And I promise that I will read it to learn.
Great.
Thanks.
Excellent. Thank you. Thank you.